For this example, we're going to walk through the entire accounting cycle, starting with the journal entries and ending with the post-closing trial balance. On the first tab, we have a listing in chronological order of the transactions for the month for Cleaners R Us Dry Cleaners, which was opened on September 1st. And if you clicked on the tab for the journals, you'll see that we have all of those transactions journaled in a chronological order. But let's just take a few minutes to review some debits and credits and walk through how we can look at these different transactions and translate that into a journal entry. So on the first one, on September 1st, stockholders invested $10,000 of stock for $15,000 in cash. So first we'll think of all of the accounts that would be affected by this transaction. Cash is coming in. We're going to have common stock for the par value of the shares, and the additional amount will hit additional paid-in capital. As far as normal balance, our assets are going to be our debits, common stock will be credit, and so will additional paid-in capital. And as a quick review of that, if we think of the accounting equation, assets equals liabilities plus stockholders' equity, and stockholders' equity, let's think of some major components. We've got revenues, expenses, dividends, and common stock. So our assets on the left, those are going to be debit balance accounts, and on the right, overall, we'll have credits. Liabilities are a credit, and all of our stockholders' equity net will be a credit. But individually, we've got equity accounts that offset each other within that equity account. And so we've got revenues, we'll have credits, expenses are debits, dividends are debits, and common stock is a credit. So the accounts that increase equity are revenues and common stock, and think of these two as the draws against equity, expenses, and dividends. So those offset those credits. But overall, the credits should, in a positive, in a healthy company, the credits should outweigh all the debits. Okay, so those are our normal balances, and then we determine whether or not we're increasing or decreasing those accounts. So cash, we're increasing, common stock, we're increasing, and additional paid-in capital goes up as well. So as long as you have an increase in this column, we're going to do whatever the normal balance is, because we want to increase that account by adding to its normal balance. So we'll end up debiting cash for the entire amount of $15,000, crediting common stock at par. So remember, common stock is always listed at par value, and additional paid-in capital will be for the difference. And so let's just peek at the journal, and if I go up to the top here, you'll see that here's your cash debited, listed first, and then you've got your common stock and paid-in capital. The next one, we've got a purchase of a used truck. So we'll have equipment, and we're going to pay cash for part of it, and the balance is on account. Balance would go into accounts payable. Equipment's a debit balance because it's an asset, and cash is a debit, and accounts payable is a liability, so that's a credit. And in this case, we're increasing our equipment, and we're decreasing our cash, and we're increasing our debts. Okay, so in this case, we're going to debit equipment. We're going to do the opposite. We're going to decrease cash, we'll credit cash, and we're increasing our payables, so we need to follow that with an increase. We've got a note payable for $7,200, and so cash is going to come in. We're going to take out a loan, and we'll have a note payable as our second account. Assets have debits, liabilities have credits, and we're increasing cash, and we're also increasing our debt. So that's going to follow with a debit and a credit. We're going to purchase supplies on account. So supplies is going to go up, and it's on account, so that means we're not paying cash. It's a payable. And so we're increasing our supplies, increasing our debt, and so we're going to debit supplies and credit AP. Next, we're going to pay cash for an insurance policy in advance, so that's going to be prepaid insurance and cash. Those are both debit accounts because they're both assets, but one is increasing but cash is decreasing. So we're going to end up debiting prepaid and crediting cash. Here we're going to bill customers. So we're not collecting cash, we're billing them. So we're going to have accounts receivable in this case. And we'll have, for services, it will have service revenue. Okay, receivables is a debit account, revenue is a credit account. Increasing receivables, increasing revenues. We're going to debit AR and credit revenue. Next, we're going to pay cash on account owed on truck and $500 on account owed on cleaning supplies. So we're going to pay off our debts. So we're going to pay cash and we're going to decrease our accounts payable. Cash is a debit account, accounts payable is a credit account, and we're decreasing cash and decreasing our debt. So we'll end up crediting cash and debiting accounts payable. So that gives you an idea of the steps to walk through for at least the first half of these entries. So if you do need a review, just remember that you go back to this basic accounting equation, identifying the accounts as either an asset, a liability, or as equity. Remembering that equity is a little trickier because it's got some accounts that will increase equity when they exist and some that will draw away. And after you take this framework, you identify the accounts that are affected, you know what the normal balance is, and determine whether or not you increase or decrease, and that will equate to a debit or a credit. So in our next tab, in a chronological order, this is your journal. So you're recording all of your transactions in a chronological order. You've got all of your debits and credits for all of those transactions listed here. The ledger is next, and that's where you're going to take all of those individual amounts in the journal entries and put them as a debit or a credit so that you can determine what the ending balance is in any particular account. And just as a review for this, you're going to add up the left side, the debit side, you're going to add up the credit side, and you're going to take the difference. And the difference will either be a debit or a credit depending on which one was larger. In this case, we had more debits than credits. The difference, the net amount, is $12,200, and that sits on our debit side. So basically, when we look at the journals, we can't tell what balance we have in cash by just looking at this. That would be very confusing. So the ledger determines what our ending balance is in every single account.